Today we're looking at the bull case for NIO stock, a special report that's really focused on this potential 2x upside from a $15 price target.
Yeah, a very bold target. So let's just jump right in on the structure.
Absolutely. The first thing that really hit me was the disconnect between the headline and the actual argument.
That's it, exactly. The aggressive $15 headline, it creates this immediate friction with the analysis in the body of the piece.
Right. The title promises you can 2x your money, but then, almost the first thing the analysis does is call that scenario extremely optimistic.
And then it immediately grounds itself in the analyst high of, what, $8.60?
Which is a totally different story.
It is. And that's the structural weakness. You're setting this massive expectation, but then you spend all your energy justifying a much smaller upside. A move to 860 is like a 40% gain.
Not the 100% promised. It just makes the reader feel like the title was,
It was clickbait. And that undermines all the strong fundamental work that you present later on. It's a real shame.
So how do you fix that? How do you commit to the premise without, losing that data-backed integrity?
I think you've got two clear paths. You either fully commit to that headline, really lay out the non-consensus path required to hit $15.
Make the speculative case, but make it strong.
Exactly. Or you adjust the title to reflect the more data-supported target.
Something like NIO's confirmed momentum, the path to Wall Street's $860 high.
Perfect. That aligns expectations immediately. Alternatively, you could keep the big title, but you'd have to restructure the body. Isolate the immediate bull case for 860 from a very separate, very clearly labeled what-if scenario for the $15 target.
I agree. That structural disconnect is jarring. But okay, let's dig into the substance of the bull case itself. The path to profitability section is key, right? It's the biggest bear argument.
It is, and to really solidify the bull case, I think that link between the explosive growth and the margin improvement needs more proof, more quantitative proof.
The argument highlights these incredible delivery numbers. I think it said 40,397 in October 2025, a 92% year-over-year jump.
The scale is explosive, no doubt. But the efficiency gains that come from that scale are presented, qualitatively.
You mean it just says shrinking losses and improving margins?
Exactly. The narrative relies way too heavily on the future Q3 earnings report to provide the proof. You should be using the data you have now to establish that proof.
Create a sense of urgency.
Yes. Make that Q3 catalyst feel like a confirmation of a fact you've already established, not just a hopeful pivot.
Okay, so give me a concrete example. What would that look like?
Well, the delivery data is precise, so use that. Try to quantify the sequential loss reduction or the margin improvement from Q1 to Q2 of 2025. Even if you have to use consensus estimates, it shows the rate of change.
Show the trend that's already happening.
You've got it. Explicitly connect the, 913,000 cumulative vehicles delivered to an expected milestone in manufacturing efficiency. Show how that is directly driving the improvement in vehicle margins. Show the engine is already running.
That makes the argument so much more robust. Okay, so we've really focused on two essential fixes here to maximize the impact.
Yep. First, reevaluate that structure. Make sure the title's promise aligns with the analysis you're actually presenting.
So either focus on the realistic $8.60 target or really build out and justify that speculative $15 scenario.
And second, you have to strengthen that profitability argument. Don't just rely on the explosive deliveries data.
Quantify the sequential improvements and link those efficiency gains directly to the numbers.
Exactly. Nail those two high-level adjustments and the piece will be much, much stronger.
And when you do, send the next